Right, quick question for you. If your household income stopped today, how long would you last before things got spicy? Be honest. No, I'd be fine kind of bravado. No, I'd simply manifest more money. How many days until it becomes beans on toast and then just the toast? Because this is the bit that shocked me. Research in the UK found that on average, people think they could survive about 60 days on their savings. But when you calculate it based on real spending and savings patterns, it's more like 19 days. 19. That's not financial resilience. That's a long weekend and a questionable Amazon order. Today we're doing a proper deep dive on what this tells us about UK home finances, and most importantly, what you can actually do about it. Before we get stuck in, this is general information, not personal financial advice. Everyone's situation is different, and if you want advice, you just speak to a qualified advisor who can look at your numbers properly. Then obviously, because I talk a lot about mortgages, think carefully before securing debt against your home. Your property may be repossessed if you do not keep up repayments against your mortgage. Cool, now let's get to the real world. When you hear days to the breadline, it sounds dramatic, like some kind of Victorian novel, but it's actually a really practical idea. This report, which is from 2022, basically asks, if your income vanished and you had to rely on savings, how could you maintain your current spending? And then it goes one step further. Even if you cut down to the basics, housing costs, utilities, food, essential bills, how long would you last then? Now, what I like about this is it's not a feelings question, it's just pure maths. And the maths is not cuddly. So the report found that people think they can survive around 60 days. But in reality, the average is more like 19 days. And even after cutting down to the basic, it only moves up to around 22 days. So if you've ever thought, if something happens, I'll just tighten my belt. According to this data, tightening the belt buys you an extra 3 days. Now, before anyone panics, this is an average. Some people have months and months saved up. Some people have less than that. But as a national snapshot, it tells you something very important. A huge chunk of the UK is operating with very little buffer in play. And when you've got a little buffer, some shocks become big problems very quickly. So here's where it gets interesting, because people assume this is only a low-income issue. The report found the reduced deadline shows up across income levels, even for households earning over 50k. Now, obviously, higher income households can often build bigger savings, but lifestyle inflation is a sneaky little gremlin, yeah? And you don't just buy a bigger house. You buy the bigger heating bill, the bigger council tax, the bigger how is it possible to spend that on grocery shopping bills. And the report also talks about what's left after the basic costs. It found that after covering basic costs like housing, utilities and food, the average household has about £700 left per month to cover everything. That's fuel, phones, broadband, life stuff. And that figure had fallen about £100 since 2020. Also, 1 in 3 households has less than £500 left after basic outgoings, and 1 in 17 is left with nothing. And nothing is a terrifying budget category, by the way. You can't cut back from nothing, you can only fall over. And this is where mortgages come in, because for most households, the biggest monthly commitment is housing. If your mortgage is stretching you so that you've got no breathing room and you're not just paying for a home, you're paying for stress. And of course, then on top of that, your fixed rate is ending soon. The timing of that change matters a lot more when your buffer is so thin. So let's get to the bit that I think makes this whole thing real. The report gives a snapshot of savings and debt, excluding mortgages and student loans, and it found the average household had £2,431 in savings and about £610 in debt, meaning that real savings after subtracting debt are close to £1,821. Now that's an average, but look at the distribution. 37% have less than £1,000 in savings, including 16% have no savings at all. And it also says that a majority have some form of debt, which for some households creates a negative true savings. So when someone says, I've got savings, the follow-up question is brilliant, but how much of that is actually yours once we subtract the debt that still needs paying? Because debt doesn't politely disappear during a crisis. It doesn't go, oh, sorry, bad timing, I'll come back later. So now let's translate this into normal life. If your car dies, if you're off sick, if your boiler decides to become a modern art installation, you need cash fast. And if your savings are mostly going to clear overdrafts and credit cards, then your buffer is smaller than you think. Now, I am going to get local for a second here because national averages hide what's happening in different parts of the UK. The report breaks down days to the breadline by location. And you can see substantial differences region to region. For example, it highlights East Anglia at around 31 days, compared to the North East at around 12 days. And for my lot in the East Midlands, it shows around 19 days. So if you're watching this in Leicestershire, Warwickshire, Northamptonshire, Nottinghamshire, Derbyshire, that 19 days, that's you. That's uncomfortably relevant. And here's why that matters for homeowners and buyers. House prices, wages, commuting costs. House prices, wages, commuting costs, childcare costs, rent levels. These vary massively, which means the same mortgage payment can feel very different in different places. So if you're local and you're thinking about buying this year, remortgaging, debt consolidation, or even just how do I make life less stressful, this is the backdrop we're operating in. The report found around 9 in 10 people were concerned about the impact of rising costs over the next 12 months. And when people are under pressure, they start cutting back. It also said that almost 2 in 5 had already cut back on food. 41% have been forced to use less heating and lighting. And on drivers, almost half had cut back on fuel usage and chosen to drive less. That's not, I'm swapping Netflix tiers. That's, I'm rationing the goddamn basics. It also means that luxuries like eating out and holidays are most likely to be reduced, which makes total sense. But there's a fascinating nugget in there. Over half do not expect to cut back on broadband. And honestly, I get it. Broadband isn't a luxury anymore. It's school, work, bills, banking, life admin, everything. So when you're doing a budget review, you've got to be realistic. The goal isn't live like a monk. The goal is build enough breathing room that life doesn't collapse the moment something goes wrong. And here's a massive behavioural point in that report as well. It says around 2 in 3, 67% of people would rather save up for unforeseen events than insure against them. Now, ultimately, that sounds sensible until you remember the earlier bit. Most people don't have the savings. So what happens is we intend to save, but real life eats the savings. And then when something does happen, illness, a redundancy, a family shock, people are forced to borrow or drain what little they have or miss payments. And that's why this matters for homeowners. Because when a mortgage is in the background, the margin for error is so much smaller. Also, the report notes that overall 39% of consumers have at least one protection policy. And that figure is lower amongst lower income households. So we've got a gap between what people hope they would do and what their finances realistically allow. And bridging that gap is the whole game. Now, this next section is one of the most relevant for mortgage holders. The report says that households often overestimate the support they could rely on from savings, work, and the state if they couldn't work due to, say, illness or injury. It also says that 8 in 10 are concerned about at least one issue affecting their ability to work. And it highlights mental health as a major worry, especially for younger people. And then it gets very practical. It talks about what people say they would rely on if they lost their job, including savings, employer support, the state, family and friends, plus cutting back. And it notes that based on current behaviour, it would take households around 3 years to save enough to feel secure and 10 years to save their gross income. Now, I'm not here to scare you, but I am here to say if you have a mortgage, the question isn't only can I afford it when everything is normal? The question is, can I keep the roof over my head when life is not normal? And this is why I bang on about protection insurance so much, because the most common financial disasters aren't always dramatic. They're often quite boring. A slow decline in health, a forced career change, hours cut, a business that had a quiet period. Boring problems can still wreck a household. Even though the research is from 2022, this stuff still feels very, very current in spirit. The report says the cost of living concerns impact how people think about insurance, and that within the next 12 months, 27% of people with house, car and life policies said they would intend to cancel one or more of those policies. And here's the trap. When money is tight, people cut the things they hope they won't need. But the reason you have insurance cover, the reason you have protection, is because the bad days are unpredictable. So the question isn't or shouldn't be, can I save £20, £30 or £50 a month? The question is, can you afford not to? If the bad day happened, would I swap £30 a month for the ability to keep my home? Now again, this isn't me telling you what to buy. It's me saying don't cancel important safety nets without doing the maths properly. There's often options to review. The sum assured, adjust the terms, check what's duplicated via work, restructure to fit the budget without leaving yourself totally exposed. So let's finish this up with something useful. If you want to improve your financial resilience, your days to the breadline, here's some practical moves that can help. First of all, know your number. How many months of core bills could you cover if income stopped? Not ideal spending, not holiday spending, core bills. Separate your buffer savings from your nice savings. Emergency fund first, then the fun stuff. Reduce down that expensive revolving debt because it just shrinks your true savings and increases your monthly commitments. Review your mortgage before it becomes urgent. If your fixed rate ends in the next 3 to 6 months, early planning can give you options and reduce those panicking decisions. And then stress test your budget. What happens if rates rise? What happens if your income drops? What happens if car expenses hit? And then if you have dependents, consider the can't work scenario. Not because you're expecting it, but because it's one of the most common ways that finances get derailed. None of this is about perfection. It's about reducing fragility. Because a fragile budget turns normal life into a goddamn horror film. If you've watched this so far, then here's a simple takeaway. A lot of UK households have less buffer than they think, sometimes dramatically less. If you're a homeowner or you want to be one, buffer matters because it protects those choices. If you want a no-pressure second opinion on your mortgage setup, especially if you're coming off a fixed rate soon, or you want to sense check your budget and options, then drop me a message. If you're local to the East Midlands, Leicestershire, Warwickshire, Northamptonshire, Nottinghamshire, Derbyshire, I am happy to help, but I work with clients up and down the UK. Drop me a like and a follow and hit the links in my bio to get in touch. Speak to you soon. Bye-bye.